Good evening, sir.
Please, I hope you are all doing well.
Yes, please, yourself.
I'm shining by grace.
We thank God.
So, management accounting. A lot of people underrate this paper, but trust me, it can be a real headache. But the question is, why do people fill this paper in the first place, right? Now, if you want to know what the pain points of students are, make sure you read the examiner's report. Right? It tells you a lot of people are not well prepared, that's for sure. 2, English language, handwriting, big problems. Are we okay? Shall we pray? Father, we bless your name. Thank you so much for bringing us together as a family this day. We pray that you come and take absolute control. Be with us. Grant us your divine grace and mercies and show us the way as we commit today's lesson into your hands. Amen.
Amen.
Okay. So management accounting, when you look at your syllabus, it gives us the aim of the model. And this is what you have to focus on to know exactly what they want from you. What does ICAGH want? To ensure that students develop a knowledge, an understanding of what various budgeting and cost accounting principles, concepts, and techniques that are appropriate for planning, decision-making, and control. So when you see all these things you are learning is for what? Actually attaining what? These 3 things. So your whole syllabus is a focus on planning, controlling, and decision-making. Or planning, decision-making, and controlling. Okay, and that's actually how your book has been structured. And the ability to apply. So at the lower level, which is introduction to management accounting, right? What you do is that these things, you only look at the theoretical bits, right? It's more theoretical at the lower level. However, there's a bit of practicality, just small. But at your level, everything is purely practical. And the ability to apply these in the generation of management accounting reports. We see management accounting reports. That means the student must have another competence, which is to generate reports from the analysis that he or she has made. Okay, so you are also introduced to key management accounting concepts also applied in the public sector, right? Like program-based budgets. Are we okay? I hope that is okay. So this is the key thing. Everything in management accounting is about planning, controlling, and decision-making, right? So planning is simply setting goals and showing how these goals can be achieved. Decision-making is making a choice from alternatives, and controlling means setting targets and measuring your actual performance against those targets, right? If you have deviated, that is what we call variance, right? You try to find a way to control that variance or start the whole process again. So your whole syllabus, in a summary, is about planning, controlling, and decision-making. So there are various topics that fall under planning, those that fall under decision-making, and those that fall under controlling. Would you want me to break the various topics into the 3, or we should just proceed?
We can break them down.
Okay. So let's see. What key topics in your syllabus relate to either of these areas? So let's see. I hope my screen is visible and my voice is audible.
Yes, sir.
Okay, so let's first start with planning. Okay, so when it comes to planning, the first topic you have to understand, I'm going in the order of how the syllabus is structured, is cost estimation, right? When we say cost estimation, simply we are talking about costing. So the basics of costing, including what? Activity-based costing, okay? Activity-based costing. And then you can also talk about what? The models of evaluation. So models for costing, modern costing environment or modern costing techniques. So under modern costing techniques in your syllabus, some are hidden, but they are still there. Some things like life cycle costing, you don't see directly on the syllabus, but it's part of environmental management accounting. So life cycle costing, you have target costing. The target costing is part of cost control and cost reduction and value engineering. These things you have to understand. When it comes to your level now, these are the things that you have to understand. Then overhead planning, right? Major part of your syllabus. However, you don't see it in a book just like that, right? Planning of your overheads, right? Which we call what? Using OAR, right? OAR, overhead absorption rate, total budgeted overheads, right? The word is budgeted overheads over total budgeted what? Absorption basis, right? So then you have budgeting. We need to know budgeting. Budgeting can help in cost estimation. It can help in planning. That's the main topic, budgeting or forecasting, right? These ones are the areas that management uses in what? Forecasting or uses in planning, right? These are the key areas in your syllabus that focus mostly on them. Planning. Now, when we move from planning, the next area has to do with decision making. Okay, so when it comes to decision making is very broad. We can actually break it into short-term decision making techniques. So when it comes to short-term decisions, in your syllabus, we first have the first marginal costing techniques. Okay, so for marginal costing techniques, there are two key techniques that we are concerned about, right? So there's one technique which we can use under planning and also decision making, which is throughput accounting. But I mostly like to keep it here because it's related to marginal costing. That's how I group things so that students can always relate. Okay, so marginal costing techniques. We first start with the modern costing techniques, which is throughput accounting. Okay, throughput accounting, which is a specialized form of accounting, right? That looked like overcame the mistakes or the weaknesses of marginal costing. Then we have limiting factor, learning how to use limiting factors, learning how to do CVP analysis, which is cost volume profit analysis, right? Or some people call it break-even analysis. Why cost volume profit analysis? Because it tells us how cost and how cost and volume should change to affect the profit, right? Or how either of these variables should change to affect the other one. So it is a sort of sensitivity analysis that if this changes, what will change here, and so on and so forth, right? So it helps in knowing what to produce, what to choose from, and so on and so forth. Now, when you understand these key management accounting techniques, okay, I can also bring contribution analysis, right? So sometimes, though it is not a separate decision per se, but there could be a question where you are going to use contribution to do everything. Okay, so as part of short-term decision making, there are some costing. You need to really understand costing before you can do decision making, because decision making is all about what? Relevant costing, right? So once you have been able to do the marginal costing techniques, then the next area is about relevant costs. Okay, so using relevant costs, so minimum pricing decisions. That is where you look at where the relevant costs are less than the price offered by the client. So the relevant costs are like the minimum price. Okay, so for instance, let me go down a little for you to understand. So look at this. The relevant cost, I just told you that the relevant cost of a particular item is actually the minimum price that can be offered for that item. Do you get it? Because it's even lower than the actual cost. So look, if I calculated total relevant cost, I getting it, of a contract to be worth 100,000 cedis, and this is like the minimum cost, and a client asks for a contract and he says he's willing to pay 90,000, should we accept or reject the offer? Should we accept or reject the offer?
Reject the offer.
Why? Why should we reject the offer?
Because what the client is giving is offering is less than the relevant cost.
Yes, of course. Okay, so this is where it starts. You must understand relevant cost. And relevant costs and revenues open doors to other techniques under short-term decision making. Okay. So you need to know how to do shutdown decisions, make or buy decisions. And if you make or buy, you must know there are different types. One, that's where you have spare capacity under make or buy. And when there's spare capacity, sometimes you can use it to take special orders. Okay. And when you have limited capacity, this one too, we can use it to look at a key factor analysis, right? Looking at a limiting factor of some sort. So ICA normally, they can bring the normal type, the spare capacity type, where you take up a special order, or where there's limiting capacity, where you use a key factor analysis or limiting factor decision. Then apart from that, we have special order decisions, okay, where you have a spare capacity, but it's not under make or buy condition. So most of the time we call this accept or reject decision, okay? And this one, it can come out of the blue, okay? So they will tell you, Kofi wants to go to school, or he should stay home. If he goes to school, these are the costs. If he stays home, these are the costs. So should you accept or reject, right? That's a type of decision you can even do with CVP as well, to accept or reject another. Then we have pricing decisions. Okay, this diet, you'll be getting a question on pricing decisions. So pricing decision is also, okay, are you using a full cost approach for pricing, full cost plus some profit margin or some plus some markup or something, variable cost plus something? Are you using discrimination pricing, premium pricing? Apart from that, elasticity of demand, I get in it, and so on and so forth. Okay, all these things are under these ones are all short-term decision-making techniques in your syllabus. A lot of people do not even know this thing is in their syllabus. Then we go to the long-term decision-making. I'm still under decision-making. So long-term decision-making, what does ICA want you to know as part of decision-making? So when it comes to long-term decisions, okay, I'm sorry, I should have put the marks in there. When I finish, I'll break my syllabus down for you so that it makes sense. So long-term decisions, first of all, you must understand equivalent annual cost. Equivalent annual cost. Let me relate this with the time value of money, okay? Time value of money. Then once you understand this, that means here you must be able to deal with what? Annuities, both due and delayed. You must be able to deal with perpetuities. That's a perpetual annuity, okay? Both due and delayed. That's equivalent annual cost. And you must be able to do asset replacement decisions, okay? Asset replacement, okay? Asset replacement can be done in short term or long term, it depends. But most of the time, this one is rare for them to ask, but you need to know how to do it. This is where students have their problem. A lot of students do not know how to deal with equivalent annual costs. We will learn how to do that. Then the third aspect is now learning the basic investment appraisal techniques. Okay, so basic investment appraisal techniques, there are two main that you need to understand. The first is return on capital employed, or accounting rate of return, ARR. And there are two ways you can compute ARR. And the next technique you need to know is payback period. Okay, payback period. Okay, so these are the basic ones. Then fourth aspect is the discounted cash flow techniques. Okay, so when it comes to discounted cash flow techniques, in the management accounting syllabus, well, they don't go too deep, but you need to understand the KIN, NPV. You need to understand internal rate of return, IRR. You need to understand profitability index, PI. You need to understand discounted payback, the discounted payback. You need to understand the last one I want to talk about, I've forgotten. Sensitivity analysis. However, when you look in the syllabus directly, sensitivity analysis is not there. This is because it is considered part of break-even, IRR. It's a what-if analysis. Okay. I know you haven't done investment appraisal, but I'll give you a simple example for us to understand what sensitivity means, okay? So, let's take a simple example. I hope you are all following.
Yes, sir.
So let's see. Please write. A project requires an initial investment of 100,000 or so, and generates the following cash flows. Okay. Generates the following cash flows each year. Okay. So we have revenue. Let's say 200,000 per annum. You have costs. Okay. Costs 160,000 per annum. This is what we have, right? And then they tell us that the project is for 4 years. So they're giving you the 4-year project, right? And then the assets used can be sold, okay, or can be scrapped for 10,000 after the end of the project, right? At the end of the project. So we are saying that, yeah, required, we are going to actually conduct a sensitivity analysis on the following variables. Okay, so the first is the initial investment. 2, the revenue. 3, the costs. And the cost of capital is equal to, let's use 10%. Cost. 4, cost of capital. And 5, let's say maybe project life. Yeah. Now, what does sensitivity analysis mean? Okay. Now, this is a what-if analysis that signifies how a change in any of the variables used in the investment appraisal would change the decision from accept to reject, or from reject to accept, or would change our NPV to 0. So you see, it is sort of linked to break even, right? At what point does our NPV, net present value, becomes 0, provided we change any of these items. Does that make sense? So in simple terms, I know most of you have not learned anything about discounting, but then we all know that if you want to get an amount in the future, right, which is this amount is in the future, also it is your present value 1 plus a particular rate raised to the number of periods, right? Number of periods. Now, this is in the future. What if I want the present value? Then it should give me the amount, also, which is the cash flow over 1 plus r raised to the power n, right? This is your present value. Or since in mathematics we know a over b is the same as what? A sorry, a over b becomes what? B becomes b minus a. That means that this can also become what? 1 plus r raised to the power negative n. Okay. So in simple terms, I can just make it 1 over a. 1 over a to be equal to a minus 1, right? This one is better. So this one, we can use this one when we are discounting, or you can just multiply your cash flow also, which is your a times 1 over this, right? Like this, or you just divide, remember. Both of them are all accepted when you are discounting, okay? And the funny thing is that this area has about 15 marks, sometimes 20, depends on how the examiner wants to take it. So based on the information that we have been given, right, when a cash flow is the same cash flow for a number of years, we call it annuity. Okay, so we are saying that we are going to get 200,000 every year. We are going to get 160,000 also every year. So if we are supposed to discount, depending on the number of years, you are going to use it to what? Discount. So another student will decide to do this. Okay, on pen and WhatsApp. So this is what the student will do. He's going to say, okay, these are the years. Okay, then he's going to say year 0, which is today. Year 1, this 1 year after, 2 years after, 3 years after, 4 years after, right? Then he's now going to say, okay, therefore, let me bring my revenue. My revenue starts from 1 year after, so 200,000, 200,000, 200,000, and then 200,000 also. Okay. Then he's now going to take his cost out, which was 160,000, 160,000, 160, and 160. Okay. So now that he has this, he ends up with his net operating cash flows. Okay, so this is cash flow from your operations, which is 40,000, 40,000, 40,000, and 40,000. Okay, so this is what he has. Then he considers the other cash flows, like the scrap. They say we'll sell the project at the end of its life for 10,000. It means cash is coming in. You see how I gather the cash flows? Then the initial investment, which today they say we should invest how much? 100,000. It's a cash outflow. Okay. So we put all this together to get our net cash flows. Okay. So the net cash flows, which we are going to use. So actually, when we look at the net cash flows, this 100,000, this will still be 40. This will still be 40. This will still be 40. This will still be what? 40 baht plus the scrap, making 50,000. So these are the net cash flows that have to be, they are all in different years. We want their values today because of time value of money. I get it. Your currency in the future might fall because of 3 major things: inflation, risk, and interest tied up in capital, opportunity cost of capital, right? So when we discount this using the cost of capital, now we get the what? The NPV that we want, right? That's very simple. But look at the thing here. Let's discount. Discounting factor was at 10%. 10% means that we are using 10% to do our what? 1 over 1 plus r raised to the power n, right? Or simply can just do 1 plus r raised to the power negative n, just to discount, right? And get the discount factors there. So when I raise to the power 1, it becomes 1.1 raised to the power 0, which will still give me 1, right? This one will give me 1. The next one will be 1.1 raised to the power -1 will give me 0.909. Mostly the discounting tables use 3 decimal places. So it is better you use 3 decimal places. You raise it to the power 2, you get 0.826, 0.751, 0.628, right? So now that you've got these ones, you just have to multiply the net cash flows by their corresponding what? Discount factors. And when we multiply, what do we get? So in year 0, it's still 100,000, right? Year 1 will be what? Meaning we lose 10% of the value. $36,360, not so. Year 2, we have 40,000 by 0.826. That's 340. We have 40,000 by 0.751. That's 340. That's 30 and 40. Then 50,000 0.628. 31,400. So now that you have all this, that when you sum all up, it should give you the present value, which is the net because we'll subtract our initial investment, right? So what's our net present value? That's 36,360 plus 33,040 plus 30,040 plus 31,400 minus 100,000. So we get 38,840, right? As our MPV, which is positive. So literally, this project is an accept project, right? Anytime you have a positive MPV, it means that we should accept the project. But when we talk about sensitivity analysis, you see, I just decided to discount all the cash flows. What if this was 40 years? That means should a student do 0, 1 up to 40? No. When you have constant cash flows like 40,000, 40,000, 40,000, you can use an annuity factor. An annuity factor is just the sum of all your discount factors we see here. That's 0.09 plus 0.826 plus 0.751. Okay, that is the annuity factor. And we simply get the annuity factor by just taking our discount factor that we got, subtract it from 1, okay, and just divide by the rate that you are using. So in effect, if we want annuity factor for how many years was the cash flow, I get it, that we had, it was for 3 years, right? If we are using the 40,000 based on our cash flows that we had, it was for 3 years. So you can find 3-year annuity factor, which is the sum of all this one, right? So this one, annuity factor 3 years at what? At 10%, right? So if we are supposed to slot this in, we get 1 minus the discount factor at the last year, 1.1 raised to the power negative what? It was 4 years, all divided by was 0.1 because it was 10%, right? So when you have this, you can easily get the annuity factor. And this annuity factor gives us what? So 1.1 raised to the power minus 4. 1 minus the answer divided by 0.1. You get 3.170, right? So now this one is annuity factor for 3 years at 10%. And you know that in actual sense, the reason why we do annuity factor is this. Look, if you have 40,000, look, 40,000 times, let's see, we were in year 1, right? It was 40,000 times 0.909, not so? Plus year 2, which was 40,000 times what? 0.826. 3 became what? 40,000 times what? 0.751. Okay, now, let me ask you, what's the common factor here? What is the common factor here? If you are doing mathematics, what is the common factor here?
40,000.
40,000. So we are actually saying factorize 40,000 out and just add that, right? And it is true because if I have 2a plus 3a plus 4a, what is common there? Is it not a? So when I bring a out, I'm left with what? 2 plus 3 plus 4. True or false? True or false?
True.
True. So that's exactly what you do. So when you have constant cash flows, you just have to factorize all your annuities, your discount factors out. So when you have 0.09 plus 0.826 plus 0.751, Check and see if you, when you add, it's up to 3.16 now, 3.170. Check and see. Oh, we're finding 3-year annuity. I made it 4. Sorry. It should be 2.487. 3 years. When you sum this up, you realize that you get 2.24, 2.486. You see, it's closer. You get it. So that is it. So anytime you have constant cash flows, sometimes ICA, I remember those times, ICA says the project is 40 years project. Then you see one student, he used the whole 20 sheets for this question alone. He did year 1, year 2, year 3, up to year 10. Then down the page, year 11, 12, 13, 14, 15, up to 40, and he was filling in. How would you do this? By the time you are done, 3 hours is gone. So you need to learn short ways of doing this, right? So in simple terms, that is how we go. So when we are saying sensitivity, we mean that assuming we make that factor 0 in the whole analysis, what will be the impact on the MPV? You get it? So if I want to do sensitivity analysis in the old management accounting way, you will discount all the cash flows separately and see how they will pan out if one just becomes 0 in present tense. So in that case, if I want to do sensitivity, though I'll show you a shortcut which we use now. There's a reason why I'm just talking about sensitivity. You see, I'm also helping you for this diet as well. So sensitivity, assuming I should discount all my cash flows, right? Let me just say year, cash flow, discounting factor at 10%, and then my present value, okay? So I am going to take my sales and discount all my sales to present value, right? So my sales was 200,000 every year. Do you remember? Oh, why am I saying that? So sales, it was what? 200. That means I'm doing year 1 through to year 4. My sales was what? Was it not 200,000? Now find annuity factor for 2 years. It was 4 years, 3.170. When we multiply, what's the present value of our sales?
That's 634,000.
Okay, we get 634,000. Nice. This is the value of sales today, right? If we should bring all our sales to present terms, this is the value of our sales. Well, what about our cost? Let's do the same. From year 1 through to year 4, right? That means you are adding all the discount factors and multiplying. The cost was 160,000 multiplied by the same thing because it was the same, right? So we multiply, what do we get? We get 507,200, not so, which is also in today's terms, not so. Okay, let's get all our cash flows in today's terms. So now when we take this out, our net cash flows in present terms was how much? That's 126,800, not so. Is that not so? Then we have our initial investment also. Our initial investment was in today's terms already. It is in year 0 also. So they are all in today's terms, which was 100,000 also. So if we take that 100,000 out, also is remember, it's an outflow. Then we also had our scrap value, which will be sold when? In year 4, true or false? Is it not sold in year 4? We sell the asset and get back the cash flows in year 4, true or false?
True.
True. So in year 4, this one is not a group of cash flows, it's just one cash flow. So we have to discount it, right? So we get 10,000 in year 4, and the discount factor in year 4 will be what? Meaning do 1.1 raised to the power -4. That gives you what? 0.628, right? So now if you multiply 10,000 by 0.628, you get 6,280, right? So now if I should put all this together, I get by my MPV all right, which will still be the same MPV we calculated there. But you see, this one is very short. right? If you can see. So we have 126,800 minus 100,000 plus 6280. And you see, we still get back our 33,080, right? Instead of going through this long process of putting all your cash flows. However, there could be other metrics, okay, which could make it very long. But you see, when I discount all the cash flows, now they make sense. Now, when I say do sensitivity of revenue, I mean by how much must the revenue change to make MPV equal to 0? Do you get the idea? Do you get the idea? By
Yes.
how much must the MPV change? By how much must revenue change to make MPV equal to 0? So look at the simple trick. Let's do all these things and just make what? MPV equal to 0. So now we are saying that if we want to get MPV, not so, it is what? Our revenue minus the cost minus what? The initial investment plus the scrap, meboa, should give us what? The MPV, which is 0 now. Now, by how much must the revenue change? Because I know cost is 507 what? 200. True or false? Plus scrap of what? 10,000 minus initial investment of 100,000. Meboa, to give me MPV of 0. True or false? True or false? Do you know what I'm trying to say? By how much must this 634 change to make MPV equal to 0? That means make MPV equal to 0 and see what revenue will give us that 0. Make sense? So let's see.
Okay. Yeah.
So in that case, that means send all this to the other side, leaving R. That means revenue must now become what? 507,200 plus 100,000 also, minus what? Minus 10,000. That means revenue must now become how much? So revenue now becomes what? 507,200 plus 100,000 minus 10,000. You get 59 what? 597,200 also.
Exactly.
That means revenue must become 597,200 to make MPV equal to 0. So by how much must revenue change? Change, we know percentage change is always new minus old, all over old times 100, not so. So this is it. So if I want to do this, then the new revenue now is 597,200 minus our existing revenue. Was it higher or lower? Oh, it fell rather. Yes, new minus old, 634. The other was 634,000 also. All over the old, which was 634,000. So if we should put this, how much do we get? You get what? 5%, right? So this
Yes,
is like
5.8.
yes, 5.8%. So let's say 5.8%. So we are saying that revenue should what? Should fall by how much? Should fall by about 5.8% to make NPV equal to 0, or simply change the decision from what? From accept to reject. You see how it is? So you take each parameter, work it this way, and come and get what? The break-even factor. But you see, this can be very, very long, right? So this is what modern finance managers came about, and they say, okay, then if we want to get it, we should probably get something we call a sensitivity variable or a sensitivity margin, okay? And this sensitivity margin just tells us by how much the variable must change. I get it. So what we do is that we take the MPV of the particular project and just divide by the present value of, I get it, the particular project variable, right? And we will get it straightforward without needing to calculate all that. So since I'm dealing with revenue, right, I want the sensitivity margin for revenue, right? So in simple terms, the MPV of the project I know is 33,060, or was it 33,040? 33080, sorry. 33080 divided by what? The sensitivity margin, the present value of the project variable, which was the revenue. How much was the revenue? The present value. It was 634,000, not so. If I do this, what percentage do I get? Let's see. 33080 divided by 634,000. What do you get? You get about 5.21 or 22%, right? Which is closer, not so. So here you are saying that what? Revenue must what? Must reduce by about what? By about 5.22% to reduce MPV to what? To 0, or to change the decision from accept to reject. That is sensitivity analysis. People don't like it at all. Even in financial management, it looks difficult, but you see how simple it can be. Well, that's management accounting for you. I hope you learned something. Okay. So with decision-making, long-term decision-making, that is it. Now, the next part of your syllabus is about, we've talked about decision-making, right? Now we are at controlling, right? When it comes to controlling comes with what? Certain targets, okay? Certain targets, and measuring performance against the targets, right? Measuring performance and checking differences or checking variables. So certain targets comes with budgetary control, okay? Comes with budgetary control. And budgetary control is very important because as part of budgetary control, we need to know the budgeting systems. Though it's part of budgeting, you also need to know the behavioral approaches to budgeting, okay? Participative and imposed style of budgeting. Then finally, you need to know how to deal with flexed budgets. Okay, flexed budgets. Nice. So when we say a flexed budget is a budget that has been adjusted to reflect actual levels of activity. People, sometimes I watch some tutors and I'm like, they need to read further. It's not bad, but you must understand some terms to not confuse students. There's a difference between a flexed budget and a flexible budget. You read a lot of books, they said they are the same. They are not. Some people say cost item is the same as cost object. No, they are not the same. I said cost item. Cost unit is the same as cost object or cost item. They are not the same. There are some slight differences. What does it mean? This one, very important for your management accounting exam. What do I mean? With a flex budget, it means that you are changing it to reflect actual levels of activity. So this is a budget change to reflect what? To reflect actual levels of activity. Okay, so we are saying that, okay, let's say that I had some cost and revenue. Okay, this is my fixed budget. Fixed budget. Now I said that, okay, I'm expecting to make sales of 200,000, right? I'm expecting to incur costs of, let me just say, material costs of 100,000, labor costs of 60,000. Okay, so this is what I have. Then actually, what happened actually, this one was for, let's say, 1,000 units, but actually we produced 1,200 units. Okay, and the sales now became 250,000. Cost became 80,000 for material, and labor became 120,000. Okay, let's just say this is what we have. Okay, now you realize that the actual units and the fixed budgets, they do not make sense. It's like, where do you work? Oh, I work in KPMG. I'm an accountant. I take 15,000 cedis as salary, right? As an accountant, right? And then there's this guy who works at another firm, A and B. Okay, A and B marketers. He's a marketer and he's taking 30,000. Can we compare these two people's salaries? Can we compare and say one is doing well than the other? Can we? Please give me an answer. Can we compare these two people and say one is doing well than the other?
No.
No,
Why?
They are in
because
different-
they are both working on different fields.
different fields, different salaries, right? Marketer, accountant, different fields altogether, right? So in management accounting, always remember to group like terms. It will help you a lot. So what we will do is that we cannot compare these two because they are not at the same level. So let's see. Now, if we take somebody working in KPMG, not so, and we take somebody working in Deloitte, associate auditor, right? Associate one. This guy taking 9,000 and this guy is taking 10,000. Now, can we compare or we cannot compare?
We can compare.
We can compare because they are all at the same level, right? That is one thing you must understand. So let me ask you a trick now. Can we compare the figures in the flex budget to the fixed budget to the actual budget? Can we?
No.
Why? Because they are different level of activities. You get it? So it doesn't make this budget suitable for decision making. Does that make sense? Unless they are all reflected at what actually happened, which is 1,200 units, this budget becomes useless and ineffective for decision making. Does that make sense to you? So what we say is that, okay, we must prepare a flexed budget. A flex budget is a budget changed to reflect the actual level of activity. So what we do is that we flex the budget, meaning that we must change what we had already, right? So we are saying that, okay, so we know that when we take sales, we can easily get the flex. The flex is reflected at the actual level of activity. So first of all, just take your budgeted sales, your budgeted sales, that's the fixed budget, and divide by what? Your budgeted what? Units. So you want to get the per unit figure first to know how much the sales is, because you know sales is variable. If one product is 10 cedis, it will be 10 cedis. Even if you buy 100 of it, one is still 10 cedis, true or false? True. So sales becomes constant per unit. So in that case, you are saying that, okay, if I take these 200 cedis, 200,000 cedis, and divide by the 1,000 units that I have under my budget, I should end up with what? 200 cedis per unit as my selling price, right? But since I want the flex, and the flex is that the actual level of activity, I will now get what? The 200 cedis by how many units we actually produce? 1,002, right? And that gives us how much? That gives us how much? 240,000. Did you all get the idea? So you see that I took this budget, which was given, this 200,000 in the budget, right? And divided it out of the budgeted units to get what the selling price actually is. Then I reflected it at the 1,200 units actually produced. So you see now, if we are comparing this 240 to the 250, we can tell whether we did well or we didn't do well. Did it make sense? Does it make sense?
Yes, sir.
So you can do the same for, this was for sales, right? We can do the same for material. And material, per the fixed budget, material was how much? It was 100,000, right? And then we divide by the 1,000 units, right? Meaning material becomes what? 100 cedis per unit, also. So if we want the flexed material, which is reflected at the actual, also, it will become 100 per unit times 1,200 units actually produced. And that gives us what? Is it 120,000? You get it. But when you check here, material became 80,000 in the actual. We go to labor, we do the same for labor, right? Labor, now I'll just go straight. This one, labor was what? What was the labor cost? 60,000, right? Labor became 60,000. We divide by the 1,000. That means this gives us what? That's 60 per unit. But how many units were produced? 1,002. And that gives us what? Is it 74? So 72,000, right? So when you look at this, if you are supposed to prepare an actual statement now, let's prepare a flexed budget now. Then you understand what we mean by a flexed budget. Okay, so we are saying that, okay, so if I have my fixed, Usually the fixed is not important. The fixed budget is ICAGH, it's not real because it's at 1,000 what units, right? This one was at 1,000 units. Then we have our flexed budget because now both are working at KPMG. Remember, this one is what? KPMG, right? 1,200 units, the same level of activity. You get the idea. Then when we come to our actual, you see, it was also 1,200 units. So you see now we can compare both because they are all at the same number of units. Do you get it? The same level of activity. Then we find our variance, which is the difference. This one, I'll draw a line here because it's not real for decision making. So when we take sales, this one, how much was the sales? It was 200,000, right? The flex became 240,000 and actual became 250,000 cedis. Now, let me ask you, we planned to sell 240, but we ended up selling 250. We planned, this now becomes the new plan, the new budget, right? So we planned to sell 240, but we ended up selling 250. Have we done well or we have lost money? Have we made profit?
We have done well
We have
We
done
did
well. By how much? 10,000.
well.
by 10,000.
10,000 favorable variance. You get it? That's how simple this is. Then we go to our cost. Let's try material cost. How much was our material cost? Material cost per the fixed budget was 100,000 also. But per the flex budget, we got how much? Based on our calculation. 120,000. 120,000. And then this one, actually, how much did we spend for material? When we look at the budget that was given. Material was 80, right?
80,000.
80,000. Okay, let's ask ourselves. We planned to spend 180. We ended up spending 80. Yaboka na enyam faswo.
Enyam faswo.
Enyam faswo because we spent less, right? We expected to spend 120, but we ended up spending 80, meaning we saved costs, and the cost saving is profit, right? Of how much? That's about 40,000, right?
40,000.
Also, nice. Let's go to labor costs.
Yeah.
When we come to labor costs, the labor was 60,000, right? But when we look at the flexed, we flexed it at 72,000 also, but this was 120,000. So let's see. We planned to spend 72. We ended up spending 120. Have we made a loss or we have made a gain?
Loss.
Loss.
A
Of how
loss.
much?
48,000.
48,000. So this 48,000 adverse variance or unfavorable variance, right? So now if I should put this together, take all the costs out of the revenue, I can get both revenue at the budgeted level and the actual level, right? Then let's see how we reconcile the profit. So we have 240,000 minus 120,000 minus 72,000. That's 48,000 as profit here, not so. And then when we get to the actual, we have 250,000 minus 80,000, 80,000 minus 120,000, right? So we have 50,000 as the profit, right? Okay. So when they tell you to reconcile profits, which is a common question, similarly, you'll be getting that this slide too, a similar one like that. So when it comes to profit reconciliation, what you do is that you are going to take what? Your variances, okay? So I'm going to bring my favorable variances here, my adverse variances here, right? Bring my Ghana cedi sign here. So what we are going to do is that you are going to take your budgeted profit, and mostly the budgeted profit is the budgeted profit at the standard level, which is what you call the flexed, right? So you take your budgeted profit, then you add all favorable variances and less all adverse variances, and you are going to arrive at the profit you are looking for. Let's try and see. So let's take our budgeted profit. It was what? Is it not 48,000? Was it not 48,000? Then now let's add all favorable variances. Let's take our sales variance. The sales variance, was it favorable or adverse?
It
was favorable.
Favorable.
10,000. So we add 10,000 favorable. Okay, here nothing will be there. Then let's take our material variance. Material variance, was it favorable or adverse? It was favorable. 40,000. Favorable. Okay, then let's take our labor variance. Labor was how much? Labor was the only unfavorable variant, right?
48,000.
48,000 unfavorable, also adverse. So when we put all together, what do we get? You realize that the
Yes.
favorable variances summed up to 50,000 also favorable, and the unfavorable
Yes.
variances summed up to 48,000 unfavorable, which is a minus, right? So 50 minus 48 gives us 2,000 CDs, not so positive, because the positive was more than the adverse. We put it together, and then the balancing figure should actually gives us our actual profit. And when we add it up, we get 50,000. Now, the actual profit, was it actually 50,000? Yes or no?
Yes, to
Have you
50,000.
reconciled the profit?
Yes.
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 So in your exam, you will be required to calculate these variances yourself. And there's a way we calculate these variances by breaking down this. What we got based on the flex budget is the total variances. But when you break them up, you are now going to get each and every one of them based on the quantities used and the prices used. So the first part of your control in your syllabus is budgetary control, which comes with flexible and flex budget. Now, this is a flex budget, but a flexible budget is a budget which is reflected at different levels of activity. Okay, that means there's nothing like actual and there's nothing like budget, but you could get a budget like this. Let me give you a simple example. So let's say we have January, we have February, we have March, not so, and they are telling you that here you produce 10,000 units, not so. Here you produce 20,000 units, and here you produce 30,000 units, not so. And then they give you some costs, right? Let's say I've given you some costs. Let's say I gave you direct material also. Here was 40,000. Here was okay, let's say I've just given you one. This one was empty, right? I gave you direct labor. So direct labor, I decided to put here 90,000 here also. Then I gave you rent. Then I came to put 60,000 here. Then I gave you depreciation, and I decided to put maybe 10,000 here also. Then maybe yeah, I think this is just electricity. Okay, so let's just say electricity. Then I put here 180,000. Okay, so you've been given this, and they said fill in the budget, right? This is a typical flex budget. So you see all are different levels of activity. They didn't say calculate variance, neither did they ask you for what any different actual level of activity, right? So all are different levels of activity. So your duty as a student is to be able to get a total cost for each month. And how do you do that? You can easily do it, right? Direct material, direct labor are variable costs, meaning they change with the level of activity. So with these ones, they are constant per unit. It means that say bro bakuye 2 cedis, even if you buy 10,000 corn or 10,000 maize, one is still 2 cedis. True or false? True or false?
True.
True. So it means that this direct material, so far as it's variable, right, it changes. It means that one is still the same. So we can get a price of one and use it to multiply all these, and it actually makes sense, right? So let's try and see. So for direct material, we can get a material per unit. So we can just take the 40,000 and divide by what? The 10,000 units. That means each material is actually how much? 4 cedis per unit. So if 4 cedis per unit, that means let's try and see. 4 by 10,000 still gives us 40. That means it's correct. That means we can do the same for this, right? 4 by 20,000 will give us what? 80,000. By 30,000 will give us what? 120,000. You see, we've been able to fill for all the months. We do the same for labor. Labor is also variable. So in that case, okay, we can take the labor cost. Where was labor? 90. So we divide the 90,000 by the 30,000.
30,000.
Units, right? That was the level it was given. So that gives us what? 3 cedis per unit, not so. So if 3 cedis per unit, let's try and see. That means this man 3 by 10, that's 30,000, right? 3 to 60,000, 3 90,000. Yay, we've got it. Okay. So rent, we assume is a fixed cost, right? The management account, the rent is fixed. So it will be 60, 60, 60 throughout. We've got the cost, depreciation fixed. Electricity fixed. Electricity, however, can be semi-variable. I'm not talking about that. Later, we may do that so that you understand. So basically, we can get estimated costs for each level. You see how simple this is. So this is a flexible budget, and that is a flexed budget. See, management accounting is interesting. Okay, so that was the first part of performance and budgetary control. Now, the next area is to understand management decision-making, which is variance analysis. Now, a lot of people do not like variance, but I think variance is the most cheapest and most simplest area you can ever get. But people don't understand. ICA students don't like variance, but variance is so easy. So when it comes to variance, you have to basically, you must understand basic variances. Okay, so most of the time when you get questions, it will come from basic variances. And variance is simply the difference between actual versus your standard, okay? And standard is actually the budget in per unit form. Okay, so anytime there's a difference between budget and standard and actual, it results in a difference, which we call a variance. So you have to know basic variances for all the costs and the income as well, the revenue variance. Then we come and look at reconciliations. I just taught you how to reconcile variances, right? You take the budget profit, add all favorable variances, less all adverse variances, something like that. Then you learn reconciliation. Then 3, you learn advanced variances like mix and yield variances for material and labor. And this one only is used only when there are 2 or more quantities of material to be used, right? Or quantities or grades of labor. Then we look at sales mix. We look at sales mix and quantity variances, which is advanced sales variance. Then finally, you look at control ratios. So you look at control ratios. These are labor ratios, which are used to also get variances. If the ratio is 100% or more, it's a favorable variance. If the ratio is less than 100%, it's an adverse variance. That one is done in percentage terms. So we have something like efficiency ratio. Okay, we have something like capacity ratio. We have something like production volume or activity ratio. Okay, and you'll be getting something similar. So those are them. Then finally, we can, as part of our basic variances, we can mostly get a work back variance. Okay, work back variance. So these are all the different types of variance questions ICA can ask you in a diet, right? So if you know that these are, though there are other questions, right? But this is what ICA has limited itself to. And they'll be asking you questions within this, whether theory or calculation, you should be ready to deal with this, right? So variance is not difficult. Variances are actually not difficult. Would you want to try a question with me, or it's okay, we can move?
You can move, please.
Maybe you can try a question.
Okay. Because every lecturer has a way he solves his variance. But I mean, I use the same formula for all my variances so that my students don't forget, right? So remember, let me just give you a simple question. Let's say, I'll just take it from the portion of material, okay? So ABC Limited has the following standard costs, okay? Standard costs card. So let's see, this is a standard cost card. And then we have material, okay? So we have materials. We need 2 kg at 5 cedis per kg, okay? Which gives us a cost of 10 cedis per unit, okay? This is just material. I'm just doing the material side. Then I come to my actual data. Then I'll be like 50,000 kg of material, let's call it material X, of material X was used. I just did material. Let me just expand it a little so that you get the whole concept. Let's see. Yeah. So I've done material. Let me do labor. So labor used 5 hours at a cost of 10 cedis per hour. Okay. Cost of 10 cedis per hour, that's 50 cedis. Then we have variable overheads. Variable overheads, let's see, we have okay, variable overheads. Let me just give you a cost of 12, 12, right? 12. That's what I have. 12 per way, but we know that they use labor hour. Okay, let me just say this is what I've given you. Very simple question. Then maybe I may bring fixed costs. Then this cost, let me make it 20,000. Okay, Ghana cedis. Okay, that's what I have. Then I give you actual data. And I said 50,000 units or 50,000 kgs of materials were bought and used at, let me just say, 120,000 cedis. Okay, then 22,000 labor hours were used at 240,000 cedis. Then that's A, B, I say C. Variable overheads actually cost 28,500. The fixed overhead cost 40,000. So this is what we have. Okay. And 40,000, let me reduce it. I want it to be favorable. So maybe 15,000. Okay. So this is what we have. Now they are telling us to required compute all necessary variances. So that's what we have. So what do we mean? Now you have been given what cost standard. I told you variance is a difference between standard and what actual. So anytime there's going to be a difference, the difference will arise between what standard and actual. So what then do we do? So I use a roll forward approach to make variances fun. So I first start, let's say if I decide to take material variances, right? This is how I go about it. I first start by taking what my standard and actual material. Remember, a variance is a difference between actual and standard, either between, because cost or value is a sum of price times what? Quantity. True or false? Price and quantity gives us standard. It gives us our value. So material variance could be a difference in material quantity or difference in material price, right? That is it. So I first start with quantity. So I say I need standard quantity times standard price. This is how I start. But then standard must always change to become actual. So when I move like this, I change this standard and make it actual. So actual quantity, then I maintain my standard price. Then I go this way too. I change this actual quantity. Then I maintain what? Actual price, sorry, this was price. Actual price, then I maintain my actual quantity here. So you realize that when you look at it here, price and price are the same, but quantity and quantity are different, right? So that means the variance is a quantity word variance, which arises from here. If you come down here too, you realize that quantity and quantity are the same, but price and price are different. That means the variance is a price variance. So this is how I go about it. So using the information that I gave you, it will be easier for us to compute the information that we need for material. So I'm only going to do material variance. And you see that it's the same thing for labor. So compute all necessary variances if 15,000 units were actually produced. Okay, so this is what you have. So if I should go into this and say, I want to get my material variances. I'm going to put my standard quantity at my standard price, actual quantity at standard price, actual quantity at actual price. Okay, so once I have this, I can just start from below. I mostly like to start from below, go to material, actuals. When I come to actual data, they said I use 50,000 kgs, right? Which tells me that is my actual quantity. At the actual price, so gave us 120, so when I come here, I know that, okay, material gave me 120,000 total cost, so actual, right? But we used about 50,000 kgs at some particular price, so to give me this. If you like, you can divide and get the price, but I don't need that. I need this one here, actual quantity. So you just key in the parameters. This is also 50,000 kg. I put it there. Then I come here, standard price. Did we have the standard price? Yes. So go to where you see standard. When you go to the standard price, you see it's 5 cedis per kg. It was given at the standard level. So you come and just insert it where you see it. So anywhere you see standard price, put your 5 cedis per kg there. So 5 cedis per kg and 5 cedis per kg, right? So standard quantity. Remember, when we're flexing, we always multiply by what? When we're flexing, what did we multiply by? Is it not the actual units produced? True or false? When we're doing the flex budget, didn't we multiply by actual units produced?
Yes.
Yes. So all the time when you hear standard quantity, anytime you hear standard quantity anywhere, it is of actual output. So this 2 kg that we have for the standard quantity, because we are flexing, we must always multiply by the actual unit produced. So 2 kg, but the question said 15,000 units were produced during the year, right? So you just multiply. Anything you do, you multiply by this. So you are done with the material variance. That is all. So you just add up and let's see. So 2 by 15,000 gives us 30,000. By 5 gives us 150,000. So this one gives us 150,000. And then this one gives us 50,000 by 5. This gives us 250,000 for this, right? And then this one gives us 120,000. So if you look at this, the difference is in the quantity. That means this is the material usage variance. So this is a usage variance. Okay, so underline it different. So all you have to do is just subtract the top from below. That's all. The down one from the top one, the one below from the top. So you get 150,000 minus 120,000. That gives us a material usage variance. If it's positive, it's favorable. Negative, adverse, you don't have to think. Are you getting it? Because actually, this one gives us 30,000 kg. So see. Are you getting it? So we get 150,000 here. And we get what? 50,000 here. And what did I, 50 by this is 250, eh? And 30 by 5 is 150. So 250, sorry. So look, this is what it means. We expected to spend 30,000 kg. We ended up spending 50. Yaboka na enyamfaso. Yaboka na enyamfaso. Have we lost or we have gained?
Can you come again, please?
Pardon?
Can you come again, please?
We expected, see, 2 kg by 15. We expected to spend or use 30,000 kgs, but we ended up using 50,000 kgs. Have we lost or we have gained?
We have lost.
We have lost. So you see, it resulted in an adverse variance. Here, you don't have to think, just subtract. 150 minus 250, negative, so adverse, right? But other people say, we should have used 30,000 kg, but we did use 50,000 kg all at 5, meaning it's an adverse variance. I don't use that thing. It confuses students. Just go straight, papa, you are gone. So the same for price, right? Price was favorable. You can see, right? 250 minus 120. So this is the price variance. The same way, you end up with what? 250 minus 120. And that gives us what? 130, right? So you have 130,000 favorable variance. Now, if you put it together, you should get your total material variance. And that gives us what? 20,000 favorable. Also, because it's negative 100 plus positive 130, 20,000 positive. The same way, if I move straight from 120 to 150, it should be 100 and 130, right? 20, yes. If I move straight from the 150 to the 120, I should have got the total material variance. You get the idea?
Yes, please.
Okay. So you see how simple it is. You can do the same for labor. You can do the same for the overheads. You can try and see. Labor, the same thing. You can come and see 5 hours as 10 cedis per hour. Labor uses hours, not quantity, just like material. So the same way, we can come and say, okay, I want my labor variance. And then I'll come here and say standard hour. Labor is paid a rate, right? Standard hour, standard rate. Actual hour at standard rate. Then actual hour at actual rate. Okay. So I just go and pick all my actuals. So my actual labor actually cost what? You use 22,000 labor hours were used at 240,000. So I just go there and say, okay, the total cost was what? 240,000, which tells me that labor used these 22,000 hours at some particular rate to give me 240, right? But I am not concerned about that because I have the 240, which I actually want. So I repeat the same 22,000 hours here at the standard rate. The standard rate for labor was what? 10 cedis, right? It was up there, 10 cedis. Look, when we go to that side, you see labor, you see is there, 10 cedis per hour, right? Or 10 cedis per hour. So you just slot it in 10 cedis. Where do you see standard rate again? 10 cedis per hour. You put it there. Standard hour, they use 5 hours. But this must always be multiplied by the actual units produced, which was 15,000, right? You see? So you see the material too, I multiplied this by the 15,000. You see, it's still the same. 5 by 15. That's what 75,000 hours should have been used, but we use 22. Also, that means we have been efficient. We use lesser hours. So let's see if we get an efficient variance. So if we look at it, we have what 75,000 at 10, and that gives us 750,000 for what we expected to spend. But we ended up spending 220,000 cedis only. That means, have we been efficient? That's our efficiency variance. So we have to check 750,000 minus 220,000. That gives us our efficiency variance. That's 750,000 minus 220,000. And that's 530,000 favorable variance. When we look at price or rates that we pay labor, we haven't been efficient. Are you getting it? It was unfavorable. So when we come to labor rate variance, we had 220 minus 240, and that gives us an adverse variance of 20,000 adverse. So our total labor variance was what? 510,000 favorable. You see? So you do the same for overheads, and then that is it. Okay, so variance analysis, this is just the basics of it. You can use it to get the variances and reconcile and do that. Now, the other aspect of control is performance measurement. And when it comes to performance measurement, first of all, you must understand CSFs and KPIs. Okay, key performance indicators, which is your critical success factors and KPIs, be able to suggest some for companies. Now, for KPIs, we have the financial performance indicators. Okay, financial performance indicators, which basically we usually focus on accounting ratios. Okay, so we normally focus on accounting ratios, and then you need non-financial performance indicators. Okay, so here is where you look at things like quality measures. Okay, quality, service delivery. Okay, service delivery. Look at not-for-profit organizations. Not-for-profit organizations, and then the rest, right? These are all non-financial performance indicators. Very, very important. So when it comes to KPIs and CSFs, there are some two models, or let me say at your model, your level, you need to understand the balance scorecard, right? So the balance scorecard can help you in understanding how to put these measures together. So the balance scorecard is a model that breaks your financial and non-financial performance indicators or your success factors, which are your objectives, into two perspectives, financial and non-financial, but breaks it into four. Okay, so for the balance scorecard, it has the financial perspective. We have the customer perspective, which measures customer satisfaction. We have the internal business process, which is what we must do to be successful. Internal business perspective. We have the learning and growth perspective, or learning and innovation perspective, depends on the book you are using. So these are areas of performance. Then once you understand this, then you should understand divisional performance measures. Very important. Almost every diet, management accounting, this will come, right? So the divisional performance, you have to understand decentralization or divisionalization. So decentralization, its advantages, disadvantages. You have to understand performance measures like ROI, RI, and Sister Eva, okay? And also accounting ratios. These are all ratios. Accounting ratios too can be used to measure divisional performance, right? So once you have been able to understand this, the last part of it is transfer pricing. So you must understand divisional transfer pricing. So transfer pricing, no domestic transfer pricing, and a bit of international transfer pricing. But at your level, international transfer pricing, they are just going to ask you the objectives. They are not going to go deeper. So in simple terms, a transfer price is a price which is used to transfer goods, service, or property between divisions, right? Or between persons in the same group. Now, why would people want to do this? They want to do this to bypass custom controls, you know, take advantage of taxes, and also do internal controls, right? To do some sort of controlling in their prices. But sometimes the selling division may not like the idea that the buying division is bringing, and vice versa. There may be conflicts all the time. So when you give a price, the price may not agree with what this guy wants. For instance, let me give you a typical example. So let's say that Division A manufactures parts and sells to Division B, and Division B also sells to outside parties, right? Now, let's see something. Now, Division A incurs a cost of 10 cedis per unit, also to produce, okay? Makes a cost of 10 cedis per unit to produce. This is the total cost it incurs per unit. And then B wants to buy these same components at 10 cedis from A, but A can also sell it to outsiders at 15 cedis per unit. Now, let me ask you a question. Will A be happy to sell it to B at 10, or to prefer selling to outsiders? Please answer my question. Yes? Will A be happy to sell to B, or it will prefer selling to outsiders?
It
I
would
said
prefer
B,
selling to outside.
yeah, B wants to buy it from A at 10. But A also wants to sell it to people at 15 because it wants to make money, right?
It will prefer selling at 15.
Of course. So
yeah.
that will bring a lot of what? Lack of goal congruence, because to the company, it would have helped the company if B bought at 10, but A will not agree. The same way, what if B could buy from outsiders at 8 cedis? Do you think it will want to buy from A at 15? No, I get it. Meaning both parties will not be happy, which will not benefit the company in the long run. So as a student of management accounting, you need to come out with a sensitive or a sensible transfer price, right? Which is the maximum and the minimum transfer price, which is the price at which B will not lose and A will not also lose, right? So that is it. And I consider the sensible transfer price, the minimum, which is the marginal cost of A plus the contribution that will be lost if he should have sold to B instead of outsiders, right? So the thing is, the marginal cost here is 10 cedis. If I sell to outsiders, I would have made a profit of 5, right? But if I forego not selling to outsiders and I sell to B at 10, meaning I've lost 5 cedis, meaning the minimum price, I get the minimum transfer price would have been what? The 10 plus the 5, which is 15 for A. And the maximum should be something B will not lose from, right? So basically, when it comes to performance measurement, these are the key things that you have to understand. So this was just a summary of the things you need to know for management accounting. Now, when you come to your syllabus, you see the breakdown, right? So I tell my students all the time that there's some 65 marks that when you focus, you can easily make management accounting. The first is what? Contemporary approaches to management accounting. Here is where we have the models of evaluation, the theory, together with costing, right? If you master this, you are good to go. Budget and budgetary control 15, but there's no chance that sometimes you can do budget questions because they are confusing and they are time wasting, right? So me, most of the time, I tell my students, yes, if budget come, you can do, but don't focus there, okay? Leave it as your last but one question. Budget and short-term decision making. Let me just cancel them for now, right? Because those areas can be time wasting. You get the idea? So your focus area is contemporary approaches to management accounting, management decision-making techniques, that is variance analysis, and also long-term decision-making and performance. You see, when you add, you have 15 plus 15, 30 plus 15, 45 plus 20, that's 65 marks, which I always urge you to focus on. And you see the magic that you can make in management accounting. Who am I to say this? I've been teaching management accounting for over 10 years, so I know what I'm talking about, right? So that is it. So what are we supposed to know right here? When it comes to your contemporary approaches, you have to know the ethical issues in management accounting. Concept of ethics, know the fundamental principles. When you hear fundamental principles, remember Dr. Pico, right? Dr. Pico. So Pico, professional behavior, integrity, confidentiality, competence, and due care and objectivity. And there are some threats, some things that will not make people comply with these rules and those threats. For management accountants, I want you to use as if, right? As if. It could be that you're supporting the client or management, we call it advocacy threat, self-interest, maybe you are getting some bonus or performance incentives. So you do not want to comply, or maybe you feel like, okay, I'm getting this, so let me just keep quiet. Self-review, checking your own work. Intimidation, maybe they are giving you pressure or they are threatening you. Familiarity, you are too close to your boss, close family ties, long relationships, long association with the clients. Because of that, you do not do proper work, right? So you must be able to identify ethical issues that happen in a scenario. Maybe this guy was employed by the company, then he went to disclose information. It's a breach of confidentiality. You have to tell the examiner. Or maybe they were giving him some bonuses. Because of that, he didn't disclose the losses the company was making. This is what? Self-interest threat, right? So you should be able to identify them and also think about the particular thing that has been breached. Remember, anytime somebody does something wrong in accounting, it is either the person did it intentionally or unintentionally. If he did it intentionally, why did he do that? When he does it intentionally, he has breached integrity, which means to be honest all the time, and also objectivity. What made him breach these things is this threat. If he did it unintentionally, it means it's either he didn't know or he didn't exercise due care, meaning it's a breach of competence and due care. And what would make somebody breach competence and due care? That is my friend rates, okay? I make things fun. It's either he lacked enough resources, he didn't have enough time, or he didn't have enough information. So this thing can cause a breach in professional competence and due care. And then you go forward, talk about the consequences of unethical behavior if somebody goes and does something which is unethical. So very simple technique. That's all about ethics anyway. Okay, then we come to models of evaluation. That's why I tell you this area, this 50 marks is sure banker. Any student who goes to management accounting and does not make these areas is not a serious student. It means he didn't learn enough, because they've even given you the syllabus, has even highlighted what you need to know. And these things, they are in the book theory. There's no calculation, except maybe ABC and maybe throughput, okay, that you get some calculation there. But the Akana theory, why don't you master it once and for all? Get your 15, you are gone. Then when it comes to the issue of budgets, yes, there are some theories there, all right. But the problem here is the preparation of cash budget and master budget. That's where the issue is, because these things can come and waste your time, right? Now it's even okay than before. Those times budgeting was 20 marks, 25. There was you can get a very big question and you spend the whole day doing it and they say stop work. There was a question called Assembeba. A company manufactures 3 products, Assembeba and Debi. Ukabom say Assembeba Debi. Very wicked question. It can take you 3 hours, but now I see. Yeah, so that is it. So you guys, you're even getting good questions. No stress, very. And then when it comes to variance, you see all the things I talked about, you see. calculation, interpretation of variances, operating statements, reconciliation of budgeted result and actual, just like what I told you, productivity, efficiency, and capacity ratios, I told you, causes of variances, behavioral aspects, I told you about it. It's always there. This area 2 is 15. That's 30 marks on your fingertips. Then you come to decision-making techniques. These are long-term decision-making, break-even point, contribution margin of safety. I told you, we call it cost volume profit analysis, separation of cost and revenue using high-low method. It's part of costing, allocation of scarce resources, limiting factor. I told you about it. Then suitability of techniques for short-term. I told you outsource decision, retention, disposal, and also make or buy. That's shutdown. These are all part of shutdown. Make or buy, special contracts and others, special discount pricing. Then when it comes to what? Long-term decision-making, I mentioned it to you, right? MPV, IRR, discounted cash flows, payback, accounting rate of return, and also calculate MPV, internal rate of return, payback, accounting rate of return of a given project. Also, then when it comes to performance measurement, I talked about key performance indicators. I talked about it, you remember? Then sources of management information, all those things, transfer pricing, RI, ROI, they are all there, right? So basically, that is your syllabus. All the things I talked about, you see, is the same things you are seeing. Yes, but I focus on areas that you need for the paper and you need for the paper alone. I don't go and focus on things that you do not need. So that was your syllabus walkthrough. Though we didn't do anything, It wasn't fun at all. So how was the syllabus walkthrough? Are you okay at least? Have you got some open mind on the subject? So give me a review. How was it? Did you get some eye openings?
Yes, in summary, you've summarized everything. Yeah.
That's fine. I was supposed to be fast because I'm not teaching, right? I'm just giving a simple walkthrough about the things that
I think you have given us a lot of confidence that we can pass management and accounting.
of course.